Hey traders, welcome to the Bollinger Bands lesson. This one I think is going to be very interesting. I say that because I found it very interesting in researching this subject. So I am not personally experienced with using Bollinger Bands in my own trading. I understand them, I understand how they work, but I've just never developed a strategy that I personally use with this particular technical analysis indicator. But with that being said, over the past couple of weeks, even the past month or two, I've been investigating how to use Bollinger Bands in my personal investment portfolio in the stock market. So just briefly, the story behind this is that there is an Australian trader, actually lives near me, called Nick Raj. He lives about a 40-minute drive from me. I haven't met him yet in person, but I hope to someday soon. But Nick is a veteran Australian trader with a massively positive reputation in the trading industry. He's been trading for, I think, would be going on 40 years, maybe longer. I believe he started trading in the 80s. He was a pit trader initially, and then he made the transition to chart trading, to price action trading, as computers became more prominent in trading the markets. Now, a couple of years ago, I signed up to one of Nick's sort of advisory programs where he it's almost like a signal service, essentially is a signal service, where his proprietary trading system spits out trades at the end of each day based on a Bollinger Band investment strategy. Depending on the type of strategy in the portfolio you want to trade, sometimes it will generate up to 5 positions, and you need to split your account balance across 5 positions, so 20% of your capital into each of those 5 stocks. And that portfolio has actually returned quite a fair bit of money for me over the past few months since I've started trading it recently. I've been using it to manage some of my parents' money as well, and it's been going really, really well. Now, normally I don't mess with signal services. It's not really my thing, but this particular strategy has really caught my eye. I've done a lot of research into Nick's work, and I felt comfortable tagging along with his system as just another way to diversify my own trading, my own investing. Obviously, I still trade actively myself, but it's nice to have some money diversified across other strategies, and that's the idea behind following Nick's service. Now, before we continue, for any of you who are interested in finding out more about Nick Raj, because he is a phenomenal trader, an absolute legend, a very bright mind. And if you're a technical analysis trader, price action trader like I am, and I imagine most of you are, if you're interested in PineScript, you will find his educational resources and interviews on YouTube fascinating, I'm sure. He has a particularly great Chat with Traders interview, 2 of them, I believe, where he goes into great depth about his own personal trading philosophy, experiences in the markets over the past few decades, and how he's learned to adapt with changing market conditions over those years. So before we actually write our first line of code, here is an example of the script we're going to build. What it's doing here is it is buying breakouts of the upper standard deviation of this Bollinger Band. So as soon as the price closes above this upper band, we enter long. Now, it's up to you how you manage your risk and all of that. I'm not a financial advisor, and while this strategy is actually confirmed to be profitable, I've done my own testing on it, it does come with high volatility, high drawdowns, so keep that in mind. And it's also in the Australian stock market universe, so keep that in mind, although I believe it does work on the American stock market as well. I just haven't got around to testing that personally yet. But anyway, this strategy, this system, buys breakouts, so as soon as price closes on this daily chart above this upper band, we enter long and we hold our position until price closes below this lower band. Now, you might be thinking that's a lot of risk, buying at the top and only selling at the bottom. And that's true. That's why it does have a large drawdown, this strategy, depending on how you manage your risk, of course. But it also captures large moves. So this X you see here is the first time price closed below this lower band, and we exit our long position. Now, the purpose of this strategy is to capture long-term, high momentum trends in the markets. Nick calls this a momentum strategy, and it is a momentum strategy because it's looking for momentum. The Bollinger Band, because it adjusts its bands based on volatility in the market. If you're buying a breakout of the upper band, generally speaking, that means you're buying into strong momentum. But given the wide trailing stop of this particular strategy, I'd also call this a trend following strategy. You're looking for strong trends in the markets. You can see that this strategy captures several. Now, it does miss out on the tops of markets. That is one drawback of this strategy, but it also captures moves like this, buying here on this breakout of the upper band and holding for several years, it looks like, from August 2010 to May of 2012, it held this particular stock and saw an approximate return over that period of about 209%, which is nothing to cough at in the stock market, even over a 2-year period, especially when you're dealing with a lot of money. Now, even if you were to only trade this system across the 5 strongest stocks in the market, the way that one of Nick's strategies works, and you split your risk 20% across each market, that means that if you were to be stopped out, let's say you bought here, and then the market just tanked and you sold down here, yes, that is a 70% loss on this particular trade, but that's 70% loss on 20% of your capital. But keep in mind that not all stocks are going to be stopped out, and there are other techniques you can use as well, other stop loss techniques you can use to exit a position early if the market turns sour. One perfect example of that is what's called a regime filter, which I believe we've already covered in the course. If we haven't, don't worry, we'll be covering that in a lot more detail in future lessons when we start building strategies. But a regime filter is something like in this case, we're trading an Australian stock. So if the ASX, the top 200 stocks in the Australian market, the index that tracks those stocks, falls below a key moving average, then we ratchet up our stop loss to be much tighter. There are infinite ways you could do that. You could simply just start using the middle band, which is the traditional method for a Bollinger breakout strategy, as your stop loss point. So if price closes below here, you exit your position. If the regime filter turns sour, you could also use a price action based regime filter stop loss. Basically, the point is to mitigate your risk, you could employ more filters than simply just buying the Bollinger breakout and selling a Bollinger lower band breach. So before we start, I'm going to read some of Nick's book on his Bollinger Band breakout strategy. So Nick says, Bollinger Bands were first introduced by John Bollinger in the early 1980s and have since become popularized and written about extensively. Bollinger Bands consist of 3 price levels, the first being a simple moving average. An upper and lower band is then calculated based on a specified number of standard deviations above and below that central moving average. The bands therefore offer a reflection of volatility of the instrument at any given time. During periods of congestion, the bands tend to contract as volatility declines, whereas during periods of high volatility, the bands expand. Bollinger Bands can be used in a variety of ways, but as a momentum strategy tool, the most common use is entering a new position when price closes above the upper band and exiting positions when price closes below the central moving average. However, the main concern with using simple moving averages is that stock markets tend to have more noise, and therefore, more often than not, a simple moving average will prematurely close positions out. Most text and broker platforms use default settings of a 20-day simple moving average, central line, or middle line, coupled with upper and lower bands set at 2 standard deviations. Nick believes that these settings are too tight for longer-term momentum investing and need to be loosened to allow for longer hold times and to overcome general stock market noise. So for the purposes of this book, and therefore this lesson, he says some slight enhancements to the default settings will be made. Number 1. Firstly, the upper entry band will be set at 3 standard deviations, yet the lower band will be set at 1 standard deviation. Number 2, the 20-day moving average period will be set to 100 days, effectively making it a 20-week variant. And number 3, lastly, rather than exit positions at the central moving average as is common practice, we exit positions when price closes below the lower band. So that's what we'll be coding today. Let's get started. Okay, here I am with a essentially blank script with just some user inputs. So we have our 3 main inputs that we just covered. We have our upper band standard deviation, which is set to 3 by default. We have our lower band standard deviation multiplier. These are multipliers of the standard deviation of our moving average. The upper is 3 standard deviations. The lower is just 1 standard deviation. And the moving average period is 100 days or 100 bars. In this case, I'm using this on a daily chart. Theoretically, this may work on other timeframes, but this strategy is designed to be traded on the daily chart. So keep that in mind as we go through this lesson. So now we have our inputs. The next thing to do, of course, is get our indicator data. In this case, Bollinger Band information. So how do we do that? It's a little bit different to most indicators. There are a few indicators that work like this. I believe the MACD behaves this way as well, where we need to use what is called a tuple or two-play. I still don't know how to pronounce that word. But what that means is we need to get multiple values from one indicator call. So it looks like this. We need to open square brackets, and we need to list out the variable names we want to retrieve from this indicator. So normally it would look something like this. BB, short for the Bollinger Band, BB mid, BB high or upper, and then BB low or lower band. So you could call this BB upper. I think high and low makes more sense when I'm coding, so I'm going to call them mid, high, and low. And then we would use the equal sign and then the ta.bb function. BB obviously is short for Bollinger Band, and it takes 3 inputs. The series, the price series, we want to calculate this Bollinger Band on, these 3 values on. In this case, that's obviously going to be the closing price, but you could use any other price source if you wanted to. The length of our moving average is going to be our MA period, so MA period. And then the deviations, the standard deviations will be calculated based on this moving average. Above and below this moving average will be our standard deviations. So in here, we would normally put our standard deviation amount. So most Bollinger Band strategies call for 1 standard deviation multiplier for both the upper and the lower standard deviation. So upper band SD, in this case, would set our midpoint to a 100 SMA. It would set our BB high to 3 standard deviations above that moving average, and it would set our BB low to 3 standard deviations below that moving average. Now, if you remember from when I read the excerpt from that book, this is not how Nick uses this Bollinger Band technique. He uses 2 unique standard deviation multipliers for his high, his upper band, and his lower band. So we need to change our code a little bit. So if you were using a traditional Bollinger Band approach, this is how it would look. You would just call this band SD maybe, band standard deviation, and this would get you a standard Bollinger Band. And if I plot these values onto my chart, like this, and I save my code, whoops, sorry, I don't have band SD defined, so let's just set this to 1.0. Save my code. And now we have a standard, regular, vanilla, plain old Bollinger Band drawing on our chart. We have our midpoint, our upper band, and our lower band. But for today's lesson, we need to change how this works. Let me comment this really quickly, because we'll come back to these plots in a moment. But what I need to do here is change this to our upper band standard deviation, copy this line of code, paste it underneath. So now if I change this to lower band standard deviation, and I save my code, we're going to get an error because we are declaring duplicate variable names. So we need to get a little bit creative here. The way I'm going to do this is I'm going to create some throwaway variables that we don't reference in our code. Now, our Bollinger Bands for both our upper band and our lower band are going to use the same midpoint, the same SMA, simple moving average. So I can set this first variable to something like BB ignore 1, and we will not be using this variable, but we will be using this one. And then for our first Bollinger Band call, our upper band, we do want our BB high variable to be set to the upper band of this Bollinger Band function call. But we don't want the low to be set by this function. So I can change this to say BB ignore 2, and now we have 2 variables that are going to be assigned the relevant values, but we just won't use them in our script. They'll be ignored. That way we get to use the convenience of the inbuilt Bollinger Band function without having to write a custom function that accounts for the fact that we're using 2 different standard deviations for each band. And now what I can do is we can leave our midpoint on the second Bollinger Band function call, and that will just be our 100 SMA. Our BB high is now the one we want to ignore on this second call, because this second call is calculating our lower band standard deviation. So I can change this to say BB ignore 3 and leave BB low in. And now we're calling the inbuilt Bollinger Band function twice, but we're only getting the midpoint, the upper band, and the lower band with their corresponding deviations. And we are ignoring these variables here. So we're only referencing these 3, or we're only going to reference these 3 in our code. And that's it. We have our Bollinger Band values. I'll indent that a little bit to make it a bit easier on the eyes. And let's move on to detecting the breakouts and the sell signals. But before we do that, let me format our plots to be a little bit easier to understand. So I'll just copy this code over to save time. You should know how to format plots by now. Here are our 3 plots, the midpoint, the high, and the low. We have the blue color for the mid SMA, red for our upper band, green for our lower band. And in fact, we should probably change these colors around. I think that'll make more sense since we want to buy breakouts of the upper band. So green equals long, red equals sell. Now when I save my code, minimize the editor, we should have our Bollinger Bands plotting. This upper band is 3 standard deviations from the moving average, while the lower band is only 1 standard deviation. So our lower band is tighter to price action, and therefore we essentially have a tighter trailing stop, and our upper band is only going to buy very strong breakouts where momentum is strong in this market. So we have our Bollinger Bands drawing. Let's now start detecting our breakouts. So before we do that, I actually need to prepare some trade persistent variables. What I mean by that is we need to track when we are in a trade and when we need to draw our trade entries and our trade exits. So our in trade flag Boolean is going to be false by default because we're obviously not involved in a trade when we add this script to our chart. On the very first bar of our chart, this will be false. And as soon as price breaks above the upper band, we'll set this to true. That way we can track when we need to draw our sell signal. The next Boolean value I need is draw entry and draw exit. So all of these are going to be set to false by default. I'm going to indent these equal signs so that again, it's just easier on eyes. This is completely optional. If you don't like the look of this, you don't have to indent these equals. It's just a habit I've gotten into recently. And next up, we need to detect Bollinger breakouts. To do that is extremely simple. We just need to use an if statement, and we need to check if the current closing price is greater than our BB high or upper band, and we are not currently involved in a trade. So not in trade. In trade is false. Then we want to set in trade to true and draw entry to true. And I'll indent these two because why not? So now when the current bar's closing price exceeds our upper band and we are not already involved in a long trade, we will draw an entry signal onto the chart. However, one thing to mention here is that this code here will do what's called repainting. So repainting is when a signal changes its value on the current real-time bar. At least that's one definition of repainting in PineScript. So normally this wouldn't be an issue. All it means is that if the current bar is trading above the upper band but hasn't yet closed, we will get our entry signal drawing onto the chart. Or in this case, that would be a up arrow. And this up arrow would appear and disappear when price exceeds and then trades back below the upper band on the real-time bar. So this isn't normally an issue, especially if this script generates alerts and you set your alerts to once per bar close, then this repainting behavior of our script will not be an issue. But if you were to set it to like once per minute or only once, then you may get a lot of false signals. So every time price trades above the upper band, here's an example here. It's a bit hard to see, but this red bar here was trading above the band throughout the day, but then closed below it. You'd be getting alerts generated so long as price is trading above this upper band on the real-time bar. For this particular strategy, we do not want that. And so what I'm going to do is hard code my script to only detect buy signals and sell signals on a closed bar. The way we do that is using the bar state inbuilt sort of namespace or library. And we want to go with is confirmed. So now we're saying if the current bar is above our upper band and we are not currently involved in a long trade and the bar state is confirmed, meaning it is on its final tick and in the process of closing and confirming the setup, then we set our flag booleans to true. And that's it. With that code, we are now detecting Bollinger Band breakouts. However, we are only going to detect one because this code checks if we are not involved in a trade. Once in trade is set to true on a VAR variable, it remains true until we override that, and we haven't overridden that yet. So we need to detect our sell signals next. So here I'll say detect Bollinger sell signal. And this is exactly the same as our buy signal, except in the opposite direction. We want to check, is the current bar's close less than the Bollinger Band lower band? So if close is below our Bollinger Band low, BB low, and we are involved in a trade, this time we want to check to make sure we are currently involved in a trade. Otherwise, we're going to get sell signals drawing on every single bar that's below our lower band. So we check, do we have a breach of our lower band, and are we currently involved in a buy trade? So we already had a breakout and bought that breakout, and the current bar state is confirmed. Now we can override our trade boolean. So in trade is set to false, and draw exit is set to true in this case. Because remember, our draw entry and draw exit are not VAR variables, so they do reset on every new bar on our chart. And so when a buy signal is detected, draw entry will only be set to true on that bar, and then on the next bar we reset back to false. And same with our draw exit. So when we detect a sell signal, we set draw exit to true, and now we can plot our buy and sells onto the chart. I'm going to do that below our Bollinger Band plots here. We'll just say draw signals. I'll copy this code over to save time. So here we have two plot shapes, draw entry and draw exit. These will only draw the shapes if draw entry is true or draw exit is true. The first shape is a triangle up with a color of green, a location of below bar, and a size of normal. I overrode the size to normal. I'll show you why. If I save the code, we should see our buy and sell signals plotting now, and we are. Here's a big buy signal and a big sell signal. If I get rid of this size parameter and save my code, you'll see that the buy signal gets quite small when you've zoomed your chart out this far. You can barely see it. Unless you zoom right in, then you can see it. I want to make these bigger since they are rare. It's not often we get a signal, so it's okay to have very large shapes drawing onto our chart. So let me save that code. And now we have our pretty decently sized buy and sell signals. If you zoom your chart all the way out, you really can't miss them. And there's been quite a few nice trades. Here's a really bad losing trade here. Very bad losing trade there. Well, it's not that bad. 28% on 20% of your position if you were to trade this strategy the same way Nick does. If you were to also involve a regime filter, an extra filter to protect you against downside volatility, you might be able to get this loss closer to something like 20% or maybe even less depending on your trailing stop techniques when the overall market's index, price action, momentum turns sour or bearish. But anyway, that is pretty much our script, our Bollinger Band breakout script. It's quite simple. It's not a strategy script yet. I will probably convert this into a strategy script when we get to that section of the course. So I can barely say strategy right now. I've been speaking for so long on this lesson, I can't even talk properly. I need to go and get a drink of water. But before I do that, let's wrap up this lesson by adding alert functionality to the script. That's very, very simple. I'll copy the code over, and all we're doing is using the alert condition function. We pass in our conditional variable, Boolean variables. So draw entry and draw exit. You could change this variable name to something like buy signal and sell signal, but I'm just going to leave it as draw entry and draw exit since these Boolean values are only true when we have a buy signal or a sell signal. And then I title my alerts BBO, short for Bollinger Band Breakout. Then we have a buy and a sell alert, and we just pass in our ticker so that the user who sets the alert knows which cell has generated this alert. TradingView should tell you that anyway, but I like to include that in my alert messages. And you can also include the closing price of that symbol in your alert message. And that's it for our script. If I get rid of all that white space, save my code, minimize the editor, we have our completed, very simple Bollinger Band breakout script. You could obviously expand on this dramatically. We can turn it into a strategy script and calculate how much this returned over its historical price action. One thing we can't do yet with PineScript, which is extremely disappointing, and I hope they add this in the future, I really, really hope they do, is we can't run this script automatically across the entire stock market. We need to manually open up every market we want to run this script on. That's a huge limitation of Pine that I hope they're working on. I'm sure they are, or I hope they are, because that would make this sort of indicator exponentially more effective as a trading tool. If we could backtest hundreds or even thousands of stocks across a particular market, we could truly test if this strategy is robust across an entire stock market universe, like the S&P 500 or the ASX in this case. But you'll have to do that manually for the most part, which is a bummer. But why not go and test this particular approach? If you're a fan of Bollinger Bands, go and add this indicator to your favorite symbols, be they stocks or crypto. I don't think this would work very well on something like Forex, maybe on commodities. Depends on the seasonality of the commodity and if it has cycles where it's bullish for a long time or not. This is definitely a strategy more suited to stocks and possibly crypto. That's something I'm going to look into myself in my spare time. But for now, that will do for this lesson. We have our completed script. If we want to set alerts, we can select our Bollinger Bands script. And then we have our buy and sell signals. If you wanted to merge these into one alert, we could also do that. We could copy this line of code here and we could say, is draw entry or draw exit true? Then we have a BBO signal. And then we could just say Bollinger signal detected for ticker at price. Now, because our alert condition message strings need to be a constant, they cannot be dynamic, they can't change. The only way we can change text in our alert condition is using these placeholders. We can't tell the user whether this is a buy or sell signal in our alert condition function. We could do that in an alert function, which behaves slightly differently. But then when we set our alerts, we need to select any alert function call, and we can't separate our alerts like we have here. So anyway, let me save this code, open up our alerts, select our script. Here are our 3 alert conditions. We have our separate buy signal, our separate sell signal, and our combined buy and sell signals. So if you wanted to save having a million alerts set up like I do, then you could use this combined signal and just open up the charts whenever you get an alert detected and see if you have a position that needs management. Anyway, that will do it for this lesson. I hope you found this as interesting as I did researching and coding this. I'll leave some links below to Nick Raj's website and interviews with Chat with Traders if you want to learn more about his trading techniques, which are phenomenal, but don't take my word for that. If you're curious, I encourage you to go and check him out. He has a wealth of knowledge on the subject of long-term trend following and especially Bollinger Band techniques. I'll also leave a link to his book below, Unholy Grails. I highly recommend you pick this book up if you are interested in systematic rules-based trading, especially if you're interested in automated trading. There's some real gems of knowledge, experience, and techniques in that book. For now, thank you. Good afternoon, good evening, and good night. And I'll speak with you in the next lesson. Take care.